该可以了吧？对这个说，一个你这里。喂，喂，喂，啊，我在说，你能听见吗？还没，这个要延，好像还没开始。喂，啊，这里还没开始，这里还在 waiting。哦。好，开始了，这个开始了。喂，我这样能听见吗？还在你刚刚的声，就是刚刚录的声音。就声音够大吗？你问一下吧。可以。好。可以啊。测试吧。啊，可以。我就站这儿。那个谢谢大家来参加今天的活动。我们今天没有这个话筒，所以大家尽量往前面坐一些，这样听得清楚一些。Thank you everyone for coming to today's event. We don't have the loudspeaker today, so if possible, please sit up front so we can hear clearly. And we will start in a minute. My name is Ying Guo. I'm one of the organizers of BCIC. It's Boston Chinese Investment Club. BCIC serves as a platform for exchanging ideas, knowledge, and information related to finance investment between United States and China. And today we have the honor to invite 3 experts from Vacovec, Mayotte, and Singer LLP to share their expertise in the area of international and U.S. domestic taxations related to investment, as well as tax planning and tax compliance. Vacovec, Mayotte, and Singer is a law firm distinguished for its concentration in tax law, located just outside of Boston. It provides a full range of tax and related legal services to clients throughout the United States and around the world. Our speakers today are Tonya James, Arthur Kerr, and Yao Tang. Tonya is a partner at Vacovec, Mayotte, and Singer. Tonya concentrates in the area of international and domestic taxation, international business planning, and tax planning and compliance for international assignments. She has extensive experience advising clients on the legal and tax aspects of conducting business activities outside of the United States. Arthur is also a partner at Arthur is an expert in international and domestic taxation, business law, contracts, and real estate. He has extensive experience representing clients before the International Revenue Services and various state tax authorities. Yao is an associate at the Vacovec, Mayotte, and Singer. She practices in the area of international and domestic taxation, with a focus on tax planning and the tax controversies. Now please join me to welcome them. And Arthur will be our first speaker today.
Thank you. Thank you. Ni hao. So we're from Vacovec, Mayotte, and Singer, and we're a tax law firm. We do all sorts of tax for full service tax. And one of our concentrations is international tax compliance and planning. And so we're here tonight to kind of talk about investments in the US, but what we're going to start off and doing is talking about tax residency, with the difference between resident aliens and non-resident aliens. This may be information you already know. So just bear with us because we just want to kind of set the stage, because how we do our planning for taxes here will large part depend on who, what the residence is of the individual or the entity that you're doing your planning and your compliance for. So again, right away we start off with resident or non-resident, and we're talking residents for tax purposes and not immigration purposes. Okay, so tonight all resident and non-resident will be about tax. So basically for U.S. tax residents, there's two types of residents. We have a resident alien and non-resident alien. And also we have a dual status taxpayers, which is a in-between kind of thing. So resident aliens are those individuals who either have a green card or are substantially present in the U.S. And substantial presence is more than 183 days when we use a formula, the substantial presence test. And we'll go over that just a little bit more in a moment. Non-resident aliens are people who are in the U.S. for less than 183 days in a calendar year, or under the substantial presence test, or people who are exempt from the substantial presence test. And we'll discuss that a little bit more. And then, as I said, we have dual status, people who are in between. Often we see this on the year of arrival in the U.S. or the year of departure from the U.S. A visa status changes. So, for example, someone who comes in on a J or F visa to go to school or study here in the U.S. and then transitions into an H-1B or an L visa or something like that, may be a dual status taxpayer. So on the substantial presence test, I just want to spend a moment on this, because as you're doing your planning for family members, yourselves, or clients, or whoever, they, if they don't have a green card, then substantial presence is what's going to get them into the U.S. tax net as a resident alien. So substantial presence, the magic number is 183 days, which is basically 6 months in a calendar year. But what the U.S. does is look back at prior years to count the days of prior years to determine substantial presence in the U.S. and have you been here for a significant amount of time. So as the formula works, it's all of the days in the current year. And right now we're concerned with the 2016 tax filings. So when I say current year, I mean 2016 tax year. So for people who are doing their 2016 taxes, all the days in 2016, a third of the days in the U.S. in 2015, and then 1/6 of the days in 2014. So when you total these up, if you've got 183 days in the U.S., then you are going to be tax resident from the first day of presence in the U.S. in 2016. Exceptions to the substantial presence test, like I said before, exempt individuals, F/Js, visa holders. If you're a student or a teacher, there's different time periods, but for students, basically it's a 5-year period where you don't have to count days. For teachers and researchers, it's a 2-year period. There's some variations on these rules, but this is the fundamental rule. In addition to the exempt individuals, the students and teachers, medical visitors don't have to count days. If someone's in the U.S. and they've been here on vacation or for some reason planning to leave the U.S. and get sick in the U.S. and have to stay in the hospital, so it's an emergency or something like that, that period of time in the U.S. doesn't count for the substantial presence test. Similarly, people who are traveling through the U.S. and say coming from outside the U.S., stop at a U.S. airport, get off and change planes, even though they're technically in the U.S., that doesn't count as a U.S. day for the substantial presence test. And these things are important because we've seen clients who have to look at the 183-day test very carefully. We had a client last year who bought a house in Boston and had to get on a plane the very next day and get out of the country because he didn't want to become a resident alien for 2016. So, you know, that 1 or 2 days makes a difference. So it's very important to track that if that's something that you're focused on. And this 183 days, you know, since we have this look-back period, that a rule of thumb is if you have someone who's coming in and out of the U.S. for several years in a row, and they don't want to get into the U.S. tax web, they want to stay in non-resident status, 120 is the number that you want to stay below if you're going to be in the U.S. for a significant amount of time, you know, over several years, without getting into the system. Other exceptions to the U.S. residency, we have the closer connection exception. So even if someone meets the substantial presence test by doing the formula, if they are less than 183 days in the current year in their home country tax system, they can avoid being a U.S. tax resident. Similarly, with a treaty, if the individual is still tax resident back home and that country has a treaty with the U.S., as China does, there's a tiebreaker clause in the treaty that says if you're resident for tax purposes in both countries, we're going to go through this fact balancing test to see, you know, which country you should be tax resident in. Exempt individuals, like I just said, with the students, exempt from counting days. When I say exempt individuals, they're not exempt from tax. They're just exempt from counting days for the residence test. So we've got 2 types, right? Non-resident aliens and resident aliens. And basically, non-resident aliens only have to worry about their U.S. source income and their U.S. travel days, since that affects their residency. Resident aliens, on the other hand, have to worry about, you know, reporting on their U.S. tax return, their worldwide income, reporting foreign bank accounts if certain thresholds are met, and we're going to talk about that in a little bit. Reporting foreign financial assets, gifts from foreign sources, inheritances, business entities, and pensions accounts. So there are several disclosure forms and requirements that must be filed for resident aliens and U.S. citizens in order to satisfy your tax compliance. Failure to do so can result in some pretty onerous penalties. You know, there's some of the entity forms that are required to go on a tax return, if required, and are not included on the return, can have a $10,000 penalty. Also, that you have to file a complete tax return in order to get the statute of limitations to start running on your tax return. Because when you file a tax return, 3 years ordinarily to review, audit, and make changes to the tax return. If they don't do it within that 3-year period, then the tax return closes and it's done forever. If you don't have the proper disclosure forms on your tax return, that statute of limitations stays open indefinitely. So they can come back 10 years from now and assess the tax and penalties. So for non-resident aliens, there's only 2 types of filing status. We have single and married filing separate. And capital gains are generally excluded from U.S. tax for non-resident aliens. So even if they have a U.S. bank account and the U.S. bank account earns interest, if they're in the non-resident alien status, they don't pay tax on that in the U.S. There is a rule for certain people, or even though they're non-resident, if they are in the U.S. for 183 days or more in the current tax year, and they sell property and incur a capital gain, the U.S. could tax that. And that rule applies to property outside of the U.S. also. It's an obscure rule, doesn't come up a lot, but every once in a while we have someone who is exempt from the substantial presence test, so they're non-resident, but they're here for 183 days and they have a big capital gain transaction and they got to pay U.S. tax on it. So
what we're doing here tonight is to try to highlight as many issues as we can so you keep them in your mind if it pops up again in the future, something to look into. If you need more information on it, you can look into the details. So non-resident aliens, the U.S. taxes non-resident alien income at graduated rates, just the same as U.S. residents and citizens, on wages, fellowships and scholarships, business income. Those are all taxed at graduated rates. For passive income, non-resident aliens are taxed at a flat rate. And unless a treaty applies, the flat rate for most passive income for non-resident aliens is 30%. But the Chinese treaty will lower that on dividends and royalties to, I don't know if it's 10 or 15%. But the treaties lower that rate. Some treaties will exempt certain types of income altogether.
Resident aliens are subject to U.S. income tax the same manner as U.S. citizens. So as I said before, required to report worldwide income. Worldwide income subject to getting credits for taxes paid in foreign jurisdictions. We get a lot of questions from people who say, well, I pay tax in this country, so I'm all set. I don't need to pay that on my U.S. tax return. But it's not true. Once you're in the system as a resident alien, you have to report your worldwide income on your U.S. tax return. And taxes, the treaties and under U.S. law, where the government's not looking to tax income twice, just trying to source it properly. So if you have foreign source income that's taxed in a foreign country, that tax is reported on your U.S. tax return and any credits taken for the foreign taxes paid. The various filing statuses, I'm sure you're familiar with them: single, married filing joint, married filing separate, or head of household. So there's more choices than for non-resident aliens. And then we've bolded here the strict requirements for reporting offshore income, financial assets, and activities. Since 2009, this has been a real focus of the IRS to focus on the offshore compliance reporting, and so the penalties for these forms have been enforced more strictly over the last few years. The IRS has set up a voluntary disclosure program that they strongly urge people to go into if they're non-compliant with their foreign reporting, and so we've been emphasizing it a lot in these types of discussions because it's been such a big focus from the IRS, and the penalties are quite severe. So we might mention that a couple times. And also, another point, certain non-resident aliens, married non-resident aliens can elect to become a resident alien if it's tax advantage. So if we have a couple, say for example, one spouse is a U.S. resident, one spouse is non-resident alien, they would file separate tax returns if the non-resident's filing his or her own tax return, but they can make an election to file joint and report worldwide income for both people if the numbers work out. Again, I'm just pointing this out as an issue that you can spot. We try to run the numbers both ways to see which gives the taxpayers the best result, whether to file jointly or file separately. Next up, we're going to talk a little bit about estate and gift tax, and Tonya James.
Hello. So we're going to start with a discussion on estate and gift tax and how those taxes work for residents and non-residents. And they work a little bit differently. The tax rates are applied in a different way. The exclusions are different. So we'll talk about how those work. So when we start talking about gift and estate tax, we're talking about assets that you own. For an estate tax in the U.S., it's assets that you own at death. That's your estate. The U.S. doesn't have an inheritance tax. So if I die and leave assets to somebody else, my estate pays the tax, not the person that's receiving the assets. Gift tax are in gifts from me to somebody else might carry a tax consequence with it. Again, I'm responsible to pay the tax, not the person that's getting the gift. So there's a gift tax, a state and gift tax exclusion that is applicable for U.S. residents, citizens, and green card holders. And it's very specific. And the exclusion for 2017 is $5,490,000. Now, there's a lot of misinformation out there on this number that it does apply to tax residents. So if you have someone or you're someone that's here in the U.S. on an H-1B visa, so you're a resident alien, that $5 million exclusion applies to you, just like it does to a citizen, just like it does to a green card holder. Now, non-residents don't get treated in the same way. Non-residents have a very small exclusion, and it's $60,000, and it only applies for estate tax purposes. It does not apply for gift tax purposes. So a non-resident giving U.S. property as a gift, there's no exclusion at all. It's all taxable. For U.S. purposes, there are some annual exclusions that apply related to gifts, where you can give a gift, and that is not applied against your $5 million exclusion. And I'm going to call it a $5 million exclusion. It changes every year. It creeps up a little bit every year, but we just refer to it as the $5 million exclusion. As you can see, it's almost $5.5 million now. If you fall under one of these annual gift tax exclusion amounts, again, it's not applied against the $5 million number. The first is an annual exclusion. Currently for 2017, it's $14,000. It's been that number for a few years now. It gets adjusted usually by $500 at a time. So eventually you'll see it go up to $14,500. And it can be used annually. So every year you can give someone $14,000. It's not reportable anywhere. And it doesn't go against the $5 million. And it applies to everybody, not just your family, but I can give $14,000 to everybody in this room and not include it anywhere. And that's one of the questions that comes up a lot. Can I give it to my son and his wife and the children? You can give it to everybody, and as many as you want. You can do it every year. The second annual gift tax exclusion relates to gifts to a non-citizen spouse. So you can make a gift to a non-citizen spouse, and for 2017 the number is $149,000, and it's not a taxable gift, and it doesn't go against your $5 million exclusion. So the U.S. notices, takes note of the fact that one spouse wants to give assets of any type to another spouse, and if that spouse is not a U.S. person, the $149,000 annual exclusion applies. And again, that number creeps up every year. So it's $149,000 for 2017. 2018, it'll be a little bit higher. Now, if your spouse is a citizen, then you can give an unlimited amount of assets to that spouse. So for me, my husband is a U.S. citizen. I can give him everything I own. There's no gift or estate tax for that, but for talking gifts, no gift tax. And that doesn't go against my $5 million exclusion. So citizens are treated differently, residents are treated differently, and non-residents, depending on whether you're talking about gift and estate tax and whether you're talking about gift during life or something that you hold at death. Now, estate taxes in the U.S. is something we try to avoid because the rates are really high. Once you get above the $5 million number if you're a resident, or above the $60,000 number, which is really small if you're a non-resident, the rates go from 18% to 40%. And the 40% kicks in, I believe, at $1.5 million. So if you're thinking about investing in U.S. real estate and you bought a property for $3 million and you decided you're not holding it in the right way and you want to gift it to somebody, you've got a very significant gift tax when you transfer that property. We're going to talk about real estate later, but think about U.S. gift taxes and U.S. estate taxes and how significant those numbers can be in your U.S. tax planning. Now, we're not going to talk about specifically the state gift and estate taxes. In Massachusetts, you have an exclusion of $1 million, and after that, you're subject to a mass gift or estate tax. all the states are different. So I don't know how long you've all been in the United States. We have 50 states plus DC, Puerto Rico, a few other localities, and everybody's tax system is different. None of it's tied together at all. About 6 or 7 of those states have no income tax. Some of them have no estate tax. So never assume that if you have property or you live someplace other than Massachusetts, that you're going to know what the local rules are. One of the things that we use in estate planning is trusts. And I know a lot of questions come up about trusts. And trusts are very popular in the United States. And the way we use them is a little bit more unique than in the way they're used in some jurisdictions. Now, some jurisdictions don't have trusts or have only recognized trusts for a few years. In the US, they're popular. In some countries, they're even more popular, and everything goes into trusts. In the US, we're usually a little more careful about what we put into trusts because there's reporting obligations and there's things that go along with trusts. So why do we use a trust? First reason we use it is for estate planning. So it might be tax planning. We're trying to do something through a trust that we don't think we can do outside a trust. We're trying to control how assets are held. So trusts are used for estate planning purposes. A big reason that we use trusts now, so the probate process is when I die, all of my assets, if everything's in my name, everything has to get out to other people. So my children or my husband, my friends. So all of those assets have to be distributed. And that can only happen through a probate process if the assets aren't held in the right way. And the probate process, usually, if you have a lot of assets, requires a lawyer. So you're going to have to hire someone like me or Yao to help you with the probate process. If all of those assets are sitting in a trust, the trust determines how those assets are distributed at your death, and you don't go through the probate process. You know, you can save substantial amounts of money by doing that. The other thing that a trust does is it controls the distribution of your assets. So I have young children. I don't want my 16-year-old to get a lot of assets right now because what's he going to do? He's going to go, you know, buy a fancy car or something. So you want to control how those assets are distributed when they go out. So when they go to your grandchildren or your children, you want to control according to the age that they are. So we do a lot of trusts that say, dear, they're young, you know, while they're in school, college, maybe up to the age of 25, they can get distributions to pay for education and their living needs. That's what they get. Maybe they get a little other money if they need something. At 25, they might get a third of their trust assets. At 30, another third. At 35, another third. And those numbers are totally flexible. You can do whatever you want with those ages, but it controls it, especially if you have significant assets, it controls the manner in which those assets go out to people that might not be quite ready to receive a large sum of money when they're young. We also use it for non-citizen spouses. So again, when you have a citizen spouse, you can transfer to that citizen spouse whatever you want without tax. For a non-citizen spouse, you can't do that. Now, to someone that's a green card holder, a non-citizen, if my assets are under $5 million, I can still use my exclusion to transfer those assets to my husband at death, and there's no tax. But if my assets are $10 million, I can't transfer $10 million to him tax-free. My citizen spouse, I can. My non-citizen spouse, I can't. What the QDOT does is it allows those assets to be available for the use of a non-citizen spouse, but doesn't distribute them to the spouse. So they get protected from estate tax, and it's a way to say, you know, spouse, if you need these assets, they're available, and when they're distributed, an estate tax is going to be due. But if you don't need the assets, they're protected from the estate tax, and we don't have to worry about paying this additional tax at my death. So a QDOT's a very popular planning technique when you have a situation where you have a green card spouse or a non-citizen, non-resident spouse. So a trust in the US is an entity, like a corporation's an entity. A trust is an entity. So for some trusts, we call them grantor trusts. For tax purposes, they're essentially invisible. So if you set up a grantor trust, it means I'm the grantor. I put my assets into this trust. For tax purposes, during my life at least, that trust is just an extension of me. And everything that happens in that trust is as if it's happening to me. All the income that's there gets reported on my tax return, and it's invisible. It obviously becomes irrevocable when I die, because I can't revoke it after I die. And at that point, it becomes a different type of entity. It becomes a taxpayer, or like our non-grantor trust, becomes an entity unto its own that has its own assets and pays its own tax. So at that point, any income earned in the trust is taxable to the trust, unless there's distributions out to beneficiaries. So some of the income can be moved from the trust to a beneficiary if there's a distribution out. If there's distributions out of a trust like this, a non-grantor trust, or trust that exists after my life, to non-resident beneficiaries, then there's probably a withholding tax. We're going to talk a little bit more about withholding taxes later, but you don't get to avoid U.S. tax if you have, let's say you have a grandchild, or you have a spouse or whatever that's getting a distribution from these trusts that's a non-resident. There's probably some withholding taxes involved. All right, so the slides that I put together for investment in the U.S. for both securities and real estate relate really to non-resident investment, but I just want to back up for a minute before we go over these to just touch on resident investment. So if you're a U.S. resident, so you're a resident alien or a green card holder, or you've become a citizen, or you're born here and you're a citizen, holding securities, for most people, we do it just directly. So we do it, we hold the stock, or we do it through an investment company, through one of the brokerage houses, and we just hold it directly. We may hold it through a trust, like we just talked about, a grantor trust, that's just an extension of me. If I'm investing with a group of people, we might do it through an LLC. We would generally not hold U.S. securities as a U.S. tax resident in a corporation. Occasionally, I'll see it in an S corporation, but not in a C corporation. That would not be the normal way to hold U.S. securities. S corporation, just so you're familiar, is a corporation that's treated as a flow-through entity. So income earned in the S corp flows through to you as the shareholders. So for non-residents, investing in U.S. securities, there's basically 3 ways that you can do a structure. You can invest directly, you can invest through a U.S. corporation, or you can invest through a foreign corporation. And by foreign, it just means non-U.S. So any jurisdiction, American, Asian, whatever. The rules we're going to talk about are going to apply. So we're talking, could be a China corporation, could be a BVI company, it could be anywhere. So a non-resident is holding U.S. securities, and those securities are going to produce income of some type. If they produce dividends, the dividends that are paid to a non-resident are going to be subject to withholding. Under the income tax treaty between the U.S. and China, that withholding is going to be 10%. If it's to other countries with whom we don't have a treaty, it's going to be 30%. So if you have, whether it's a corporation or an individual in a non-treaty country, the withholding rate on dividends is going to be 30%. As Arthur discussed, capital gains on sales of U.S. stock, generally not taxable to a non-resident, as long as they're not present in the U.S. for more than 183 days in a calendar year. Holding U.S. securities, those are assets that are subject to the estate tax in the U.S. So if you die and you have a brokerage account that has shares of IBM and Microsoft, those assets are U.S. stocks and they're subject to the U.S. estate tax. So when we just talked about estate taxes, that can be a lot of money. They are not subject generally to gift tax. And I'm not going to try to explain to you why there's a difference. I don't really know, but those are just the rules. So if I have, as a non-resident, you own a share of IBM and you give it to somebody, there's no gift tax. If you hold on to it and you die holding it, now there's an estate tax. So they're very different rules. I don't know what the thought process is there, but the code's very specific on those items. Now you can hold U.S. securities in a U.S. corporation. And if you do that, income that's earned by those securities, income produced by those securities is taxable in the corporation. And all items are going to be taxable. So interest, dividends, capital gains, fully taxable. If you pay dividends from that corporation to a foreign shareholder, the same rules apply on the dividend withholding. So if we're looking at a non-resident living in China, it's 10%. Other tax treaty countries have different rates, usually 10 to 15%. If it's a non-treaty country, 30%. Again, the ownership of that U.S. corporation is subject to estate tax if you die while you're holding that, that corporation stock, and not subject generally to U.S. Gift tax. With a caveat that's in there that says if that U.S. corporation is holding U.S. real estate, it's a different issue on gift tax. One structure that we see if someone wants to invest in U.S. real estate and we're trying to tax plan around the estate taxes is a foreign corporation that owns a U.S. corporation or a foreign corporation that owns U.S. securities directly. And that avoids estate tax issues because your foreign shareholder is a foreign corporation. That foreign corporation can't die. So that foreign corporation just exists. You might have the shareholders above the foreign corporation pass, but when you deal with U.S. estate tax rules, the U.S. doesn't look all the way up the chain to see who the ultimate shareholder is and whether or not they're alive or dead. All right, tax planning for U.S. real estate. We're looking at U.S. real estate, again, backing up for a minute. If you're just a regular U.S. person, you're a tax resident here in the U.S., most of us hold our U.S. home, our U.S. real estate, the house I live in, just outright. So when you're a U.S. person and you own U.S. real estate in some manner, there's not a lot of ways to avoid gift and estate tax issues if I'm owning it. So most of us own our homes just directly. We just hold them, we purchase them, they're ours. Sometimes you'll own it in an LLC, and it can be a single member LLC, which basically means it's invisible, just like the grantor trust, and I'm basically treated as the owner. There's a nominee trust that's sometimes used to hold real estate. Again, it's just an invisible entity, and I'm basically treated as the owner. An LLC is going to be used most of the time if you have multiple owners. So we see multiple owners in rental properties. So if there's a bunch of U.S. people and we are buying a rental property together, renting it out, producing income, that may be the time when we use a U.S. LLC. That's only for income tax and income tax convenience. There's no estate tax protection there. There's no gift tax protection there. So basically, those are kind of the general rules when you're sitting here in the U.S. resident, intending to be a U.S. resident going forward, whether you're just a resident alien, a green card holder, or a citizen. So looking at foreign investment in U.S. real estate, the first slide here just lays out kind of what we're considering when we look at foreign investment in U.S. real estate. What rules are in play, and how do we decide what's the best way to hold U.S. real estate? The first one is FIRPTA rules. Now, there's a lot of tax planning that goes on around these rules, and probably too much, but under the FIRPTA rules, it just says that the sale of U.S. real property or U.S. real property interest by a non-resident is subject to a 15% withholding tax. So it's not a 15% tax rate, it's a 15% withholding tax. That means that you as a non-resident investor are required to file a U.S. tax return. You report the sale of your property, and that 15% that's withheld, and you might have heard 10%, but it just went up to 15% about a year ago, that is just a credit on your tax return. So you're calculating your liability, you're taking that 15% as a credit, and so you might owe more tax or you might get a refund of tax. So it's one of those things, and the IRS has been really complicated to deal with related to thrift or withholding. There's some rules in place where you can get that 15% reduced, but with my clients, I basically say that if it's the first half of the year, we'll look at trying to get a reduction. If it's the second half of the year, unless there's a really good reason, you have the withholding done and you get the tax back on your tax return, because it's really a lot easier to get the refund on a tax return rather than trying to get a reduced withholding amount. The other thing that we look at is the U.S. gift and estate tax rules. So real estate is always going to be U.S. situs property if it's U.S. real estate. There's going to be a gift tax when the property is transferred. That comes up a lot. There's a gift tax when U.S. real property is transferred. There's an estate tax if you're holding the property, or it's subject to estate tax if you're holding the property when you pass. When we talk about planning, one of the things we need to talk about is what are your long-term goals? And these goals are all over the place. And the number one thing we say, so one of the most important things you can take away from this seminar is you tax plan in advance, you don't tax plan after. Once you've already purchased a piece of real estate, your options for tax planning went from here to here. The expenses that you're going to have tax planning after the fact are going to be much bigger, and your options are much smaller. So you always tax plan in advance. So we look at what's your purpose for this property. So is it an investment property? Something that you intend to rent for a while, then you're going to sell later? Is it a property that's an investment property that you're going to, pass on to your children? I have a client right now that has a couple of rental properties in Boston, and he rents it, he makes a little money on it, but he doesn't care. He cares nothing about the rental income. I mean, he'll take it, but he doesn't really care about that. The properties are appreciating in value, and he wants to pass them on to his children. So what he sees is the long-term gifts that he's going to be giving his children at some point down the road, not necessarily what's happening right now. If it's a personal residence, so where do we see that? It's a personal residence. Lots of foreign parents buy condos in the Boston area for their children to live in. What's your plan for that property? Is your plan that we're going to buy a condo, my child's going to be in school for 5 years maybe, then we're going to sell it? So we're only holding for a period of time. Is your plan, I'm going to buy it, my child's going to live in it, my child's probably going to stay in Boston, so at some point I need to get this property from me to my child. So, that's something that's really important is looking at, what the long-term plan is. So when we're looking at how to hold the properties, one thing when we talk about long-term plans, I always ask parents that are sitting there and they're buying a condo for their child to live in, and they want to give it to the child. And by child, I mean like 18 years old, right? So they want this child to have it, but they don't want him to have it today. But they want him to have it, let's say in 5 or 6 years. We talk about the planning options there. And so let's say the condo is $1.5 million. And the parent has $1.5 million sitting in China, and they want to take that money and buy that U.S. condo, the condo that they want to eventually pass to their children. So I say to the parents, when I talk about planning in advance and looking at your long-term solutions, I understand that you don't necessarily want to give that condo to your child today. I get that, but let's look at the tax consequences of what we're doing. You give that child a gift of $1.5 million in China, and the child buys that real estate himself or herself, or in their name at least. They own the property. If you buy it and then you transfer it to your child later, now you've got a U.S. gift tax issue. So the first scenario, you transfer cash of 1.5 million outside the U.S., no U.S. gift tax issue. Second scenario, you're transferring property of 1.5 million in the U.S., now you've got a U.S. gift tax. So structuring these properly and planning long-term, we never know what's going to happen 5 or 10 years down the road. So of course we don't know that, but planning long-term in the way that we're holding assets makes a lot of sense. And again, doing it up front and not trying to do it later just really works. So options for holding U.S. real estate. You can hold it direct. So you can just buy it and hold it. And when you do that, you've got an estate tax issue if you die holding it. You've got the gift tax issue if you try to gift it during your life. And you've got the FIRPTA withholding, 15%. So we just, one of my partners met with a bank. The bank's right over the border. It's down in Connecticut. And the bank specializes in loans to non-residents to buy U.S. real estate. But they will only loan the money if you buy the property directly. So you can't buy it in an entity, not in an LLC, not in any entity. And so my partner's meeting with this bank the other day, and he says, you know, right, that you've just created an estate tax issue or a gift tax issue for every single one of these people buying this U.S. real estate. And the bank representative was horrified because they just had no idea that there's different tax issues related to how you hold the real estate. So the second option for holding U.S. real estate is through a U.S. corporation. Now, a U.S. corporation that holds U.S. real estate is going to be called a U.S. real property holding company. So essentially, it's like holding real estate for FIRPTA tax purposes, and it's subject to the 15% withholding if you sell that corporate stock. As we talked about before, the U.S. corporation has estate tax issues. So if you die holding that corporation, subject to U.S. estate tax, has gift tax issues. So remember the little caveat on the prior slides where you can transfer U.S. stock tax-free, except if it holds U.S. real estate. So the transfer of stock in a corporation that holds U.S. real estate will be subject to the U.S. gift taxes. And the third issue with holding it in a U.S. corporation is that all income coming in is subject to the corporate tax rates. And that includes capital gains. So if you sell a U.S. property and you make a profit on it, you pay capital gains rates if I'm holding it directly. Corporations don't have capital gains rates. They just have one type of rate, just regular income rates, maxing out at like 35%. So you may pay a much bigger income tax if you're holding through a U.S. corporation. The structure that we do most often for investment in U.S. property, when it's actually an investment property especially, is a foreign corporation on top. And it can, for U.S. tax purposes, it doesn't matter where that corporation is. For people that are planning, non-residents, it makes a difference to you maybe where that corporation is. But this treatment's going to be the same whether it's a China corporation or a BVI corporation or anywhere else. So we have a foreign corporation. Foreign corporation is the sole owner of a U.S. corporation. The U.S. corporation owns the U.S. real estate. Generally, when we do these types of structures, we're looking at income related to a capital gain, an exit strategy, not necessarily rental income. So when you have that type of structure, does a few things for us. From the estate tax. So again, you're way up here as an investor owning a foreign corporation. If you die, no one in the U.S. is going to know. Nothing happens. You can die holding that stock and transfer it at death. You can gift it, and there's no U.S. Tax issue with that. There's no estate or gift tax. There's income tax that's going to be paid. So again, sometimes you'll have an issue with rental income, so that's going to be taxable within the corporation. But generally, we're looking at an exit strategy for these investment properties. So You have an investment property, it's down here, you sell it. The corporation pays a tax. So it might be up to 35%, the maximum corporate tax rates. But under the US rules, you're able to take that US corporation and liquidate it out into the foreign corporation tax-free. Because of the way this structure works, you can only do a single investment in this line. So it's one US property, one US corporation, and then the foreign corporation. You don't put two properties into the US corporation because otherwise you have to sell them at the same time and liquidate out. So in this structure, which a lot of our clients invest this way when they're investing into US real estate, you pay tax on capital gains at corporate rates, but you're able to avoid all other taxes on your way out.
I would just point out that right now the U.S. corporate tax rate is the high rate's 35%, but under the Republican and Mr. Trump negotiations right now, we're trying to get it lowered down to 20%. So that may offer more of a planning opportunity, something to keep an eye on.
Another popular way to hold U.S. real estate is through a U.S. limited liability company. And when we talk about U.S. LLCs, we're talking about a single member entity that's disregarded for tax purposes, or an LLC that's taxed as a partnership. There was this trend for a while that you were setting up an LLC, and then you were making an election to tax it as a corporation, and then maybe making another election to tax it as an S-corp. Never really wrapped my mind around what was going on there to get any tax benefit. But for this, for my purposes, we have an LLC that's taxed as a partnership. Now, this is the one thing I'm going to say today that is really gray. And by gray, I mean the tax rules just aren't clear. The gift and estate tax rules related to the ownership of a partnership interest by a non-resident person is very unclear. The rules, intuitively as tax people, we would say it's subject to estate tax. That's not the way the code is written. They haven't specifically said the LLC interest is subject to estate tax, but they haven't said it's not. And all the authority out there, you have commentary that goes both ways. I wouldn't invest this way and make any assumption that I'm not subject to estate tax, because the rules are so unclear that through our office, through tax advisors internationally, the opinions are all over the place, and there's been no case that's come down. There's been no IRS ruling on this issue that's anything that we can use. So one thing we're really going to say today that, if you're investing in U.S. real estate through an LLC as a foreign investor, intuitively, we think it's taxable based on the tax code. It looks like you could make an argument saying it's not, but I would be very careful in investing in that way. Now, if you have a partnership in the U.S., you have an LLC taxed as a partnership. That partnership produces income, like rental income. If you're looking at an LLC holding real estate, when that rental income is allocated to a foreign partner, there's a withholding tax on that income. The withholding tax is the maximum tax rate for that individual. So if you have a non-resident individual investing in a U.S. LLC, the withholding tax rate is the maximum tax rates for individuals, 39.6% right now. And I didn't say the income had to be paid out. It has to be allocated to a foreign partner. So if you have an LLC or partnership that's not paying out anything, well, there has to be taxes paid, and your foreign partner has an income tax filing liability in the U.S. Those taxes should be in there. They can get a refund. So you might have a case where your foreign partner files a tax return, gets a refund, and is now holding some amount of dollars. And your U.S. partners, they don't have that issue. They didn't have any taxes paid in for them, and they didn't get any distribution when effectively the foreign partner got a distribution. So you have to be really careful on those rules. And we have a lot of clients that just ignore that rule, the withholding rule. And what I tell my clients is you ignore it at your own peril, because if I'm a partner, let's say I'm the managing partner of this LLC and I don't withhold, and that foreign partner doesn't pay his income tax, guess who's liable? Me. If I made a decision not to withhold, I'm going to be liable as part of this LLC because foreign partner might be over in China and, you know, the IRS isn't going to traipse all the way to China to try to get, you know, tax dollars out of them necessarily. That withholding rule doesn't apply when you sell the real estate. When the real estate's sold, you go back to the FIRPTA rules and it's the 15% withholding on the gross proceeds allocated to that partner. Okay, that's real estate. Foreign assets. Arthur touched on foreign assets and the reporting obligations for foreign assets. We're going to start with FBAR reporting. So the FBAR is the Foreign Bank Account Reporting Form. FBAR is the short term for it. A couple years ago, they changed the number, and now it's called Form 114. This is really important. We do a lot of work with people just like you with foreign bank accounts that haven't been properly reported. So what the IRS says is that if you have foreign bank accounts, you look at all of those accounts, you look at the maximum value in those accounts, and let's say tax year 2016, the maximum value in each account. You add together all of those maximum values. If that total exceeds 10,000 US dollars, you have an information reporting. Now, it doesn't get taxed. The IRS doesn't tax principal, but you have an information reporting. So what are we looking at? We're looking at bank accounts, and they have all different names depending on where you are. Bank account, savings account, current account, cash account. We're looking at foreign investment accounts. So if you are, you have an investment account in Switzerland with UBS in Switzerland, and you're sitting here in the US, you've probably already heard from them, but anywhere around the globe that you have an investment account, that's an FBAR reportable asset. Certain non-US pension accounts are reportable. You know, depending on where they are. So, if you have a pension account that's an account that you contribute dollars to or whatever, contribute cash to, it's probably reportable. Life insurance policies with a cash out value. With life insurance policies, be really careful because what we've learned over the last several years is what we call a life insurance policy here in the US is not necessarily what they call a life insurance policy in other countries. Generally, and I'm going to be very general here, we go buy life insurance and it might have a cash out value, but it has a value that when we die, it pays out. That's our life insurance. In a lot of countries, life insurance is more like an investment vehicle. And you might buy it for $1 million and you control what that policy is invested in. And it's almost like an investment account, definitely reportable for FBAR purposes. So there's very significant penalties for failure to report. And as Arthur said, the penalties for non-willful. So that means you didn't even know you had to report, but you didn't report, and the IRS comes knocking on your door because your bank over in China has reported you as a U.S. shareholder or a U.S. account holder. $10,000 per account per year is the non-willfulness penalty for failure to report. The IRS can reduce it. Will they? I don't know. Right now, we're just at the point where all of the foreign account holders are going to be reported back to the IRS. So we're going to see what they're going to do with those penalties. What was that? The penalty is just on not reporting. So if you have a bank account with $50,000 in, converted to dollars, the IRS can tax it, can put a $10,000 penalty on that account for failure to report it. So it's just a penalty. And the IRS has put into place, as Arthur said, some programs to bring all of us back into compliance with this failure to report. So we won't go through all the programs, but there's, for people living here in the US, so we're going to assume, since you're all here, that you're living here, there's 2 programs that the IRS has in place right now that include penalties. One of them is what we call a streamline program, and that carries a 5% penalty. There is another penalty for those that might be willful and try to hide assets from the IRS. The penalty in that program right now is 27.5%. And there's some other programs that are available for people that might have an account. So let's say you have an account sitting over in China. It doesn't earn any interest. The account was $15,000. So you didn't report it, but there's no interest that was earned. There's nothing that hurt the U.S. fisc, as we say. Then the IRS has a program where you can file those delinquently without penalty. So each case is different. We look at all the cases. The last way that you can file that we don't necessarily recommend, but some of our clients do it, is what we call a quiet disclosure. That's where you just send everything in and you hope for the best.
So just as a reminder for everybody, the reporting for the non-U.S. assets is only for resident aliens and citizens. It's not for non-resident aliens. Just to clarify.
Well, not for non-residents, although certain ones that meet the substantial presence test are going to have.
Right.
If you're claiming the treaty exemption, treaty tiebreaker rule, or closer connection, then you might have to file. Okay, so that's the FBAR. Very important because the IRS thinks it's very important. Yep, so when you look at whether or not you have to report, you look at all of your bank accounts, you look at the maximum value in each account in 2016. You add together those maximum values. If that total for all the maximum values added together exceeds 10,000 US dollars, then you have to report. So it's not reporting just for every account that goes over 10,000, it's cumulative. So you have to report all of your non-US bank accounts. No, each account's just reported at its value. So on the FBAR, the way the FBAR is set up is you report the name of the bank, you report your account number, the maximum value in that account in 2016, your bank address, and you report for every account. So it's one form, and each account is reported separately. But if your $1 million is all in one account, then it's just one line on the FBAR form. If you unintentionally don't file it, it can be a $10,000 penalty. Everything's negotiable. So it's a non-willfulness penalty. And if you, so there's, like I said, there's options for getting in before the IRS fines you, but that penalty increases. It's a much bigger number if you know that you're supposed to file and you don't. So the $10,000 is a maximum penalty for a non-willful failure to file. But if you're willful and you know you have to file, then the penalty is much higher. There's a lot of rules around what that penalty can be, but it's more than 10,000. Probably starts at 100,000.
But it's true what you said, that the IRS has some discretion on the non-willful piece. So that $10,000 penalty could be reduced if the agent's in a good mood or something like that. But there's no rule that gets you how to knock it down. So it's better not to have to fight it. But if you do have to, there is.
You get a good lawyer to help you.
Yes. That's a good point.
Yep. Mm-hmm. So we do a lot of that work for people that haven't reported. So there's programs with the IRS to bring them into compliance without having to pay huge amounts of percentages, I should say, of tax and penalties. But what happens is, let's say the streamline program. So The Streamline program is a program where, let's say Yao didn't file, she has a foreign bank account and foreign assets, whatever she has. So when we go into the Streamline program, we do 3 years of amended returns and 6 years of FBARs. So we go back 3 years and amend returns to report any income that wasn't reported. Like Arthur said, you're taxed on worldwide income. So we add that income to the returns if income wasn't reported. We take credits for taxes paid in China, and we calculate that. On the FBARs, we do 6 years of FBARs. So we take those 6 years and we add up the December 31 values for all those accounts for all the 6 years. And whichever 1 year is the highest in the Streamline program, it's a 5% penalty on that. So let's say your high net worth individual has a high year of $20 million. It's a 5% penalty on that. The IRS considers it a good deal because of all the other penalties that could be assessed that aren't going to be assessed. But we do a lot of work in that area. People all over the world, China, yeah, and I've worked on a bunch of ones from China, but all over. You know, in the Caribbean islands, they have bank accounts. Switzerland, they have bank accounts. You know, just globally. So the IRS definitely has programs to bring them in, and we go over all the options. So we go over the programs. We go over a quiet disclosure. We go over what's going to happen if you don't disclose and the IRS comes after you. So, you know, we cover it all, and we're familiar with small cases. So the $15,000 guy, we're familiar with, you know, $100 million in assets and how to deal with those.
So what is the best time to start thinking about it?
So, you know, when we look at FBAR reporting, it's all informational. So reporting your income, you know, when you're looking at becoming a green card holder, before that's ever issued, before, you know, as you're just in the beginning part of the process, you need to start moving assets and doing things as a non-resident. You know, when we have our high net worth individuals and they're looking at coming to the U.S., their tax planning opportunity, if they're getting a green card especially, is before. It's almost only before. Because as soon as that green card is issued and they enter the U.S. on that green card, they're tax resident. So at that date, a lot of their tax planning opportunities have gone out the door. And so the next slide is reporting foreign assets. So the FBAR gets filed separate from your tax return. The Form 8938, it gets filed with your tax return. It's a schedule attached to your tax return. The bank accounts that you own that are reported on the FBAR are duplicated on the 8938. There's certain thresholds for the 8938 reporting, but let's say 100,000. If you have more than $100,000 in assets, you're doing an 8938 reporting. So you're reporting your non-U.S. assets that include bank accounts and financial accounts, all the stuff we just talked about for the FBAR. It includes foreign entity reporting. So when your high net worth individuals, or maybe not so high net worth, own a piece of a company in a non-U.S. country outside the U.S., or a partnership, any of those things, that gets reported on the 8938 as an asset that's owned. Other financial assets get reported. If you're a beneficiary of a foreign trust, gets reported on the 8938, and we'll talk about some other reporting for that. If someone dies, and let's say your parent dies, and you have a 25% interest in that estate, and it hasn't been distributed out yet, and you own that on December 31, that's a reportable asset. Real estate owned directly is not reportable on the FBAR or the 8938. So if you own a house in China or in Jamaica, those houses are not reportable. If you rent those properties, they're reportable. The income's reportable on Schedule E of your tax return, but the ownership, the value of those properties themselves don't show up anywhere on your tax return. If they're in an entity, that entity gets reported. So, you know, a corporation or a trust or whatever, the entity gets reported. But any property that you own directly is not separately reportable. As with the FBAR, the 8938 has penalties. It's a $10,000 penalty, and it doesn't vary for failure to file. This is one penalty that we haven't really seen assessed yet because the 8938 just came in 2011. And the IRS systems, I think, are really just getting up to speed on who's filing this form. But eventually, the penalties will be assessed. And if the IRS audits your tax return and you needed an 8938 and you didn't attach one, you can assume the penalty will be assessed at that point. And again, it's the same programs that are in place to deal with failure to file the 8938 as with the FBAR. Non-U.S. trust. So the first thing I like to say is if you're a U.S. resident, green card, citizen, do not look at a non-U.S. trust as a good tax planning opportunity. It is not a good tax planning opportunity. There's no deferral, and all we do with foreign trusts for the most part is work on unwinding them. So for those of you that are older and you've been in the U.S. for a while, there's been lots of opportunities out there for doctors and dentists, lawyers, other high net worth individuals to put their money in foreign trusts, to hide it from the IRS, to hide it from a potential ex-spouse, somebody, creditors. It's a bad idea. There's very few clients that we have where, as U.S. resident people, we feel like a foreign trust is a good idea. If you do set up a foreign trust, you have reporting obligations at the time that you set it up. If you transfer assets to a foreign trust, you have to tell the IRS that you're doing it. So you have to file the Form 3520A. If you're a beneficiary, probably also the Form 3520. If you receive a distribution from a foreign trust as a beneficiary, you have to report that to the IRS. Associated with that, depending on what's happened in that trust over the years. Penalties relate to what we call accumulated income. So if you have a trust that's sitting in the Bahamas, or let's say Panama, and part of the Panama Papers, you have a trust sitting there, and your great-grandparents put $200,000 into that trust. It's now worth $3 million. No income's ever been distributed. Now you start getting distributions from that trust while you're sitting here. Not only are those distributions going to be 100% taxable to you, they're going to carry with it interest and penalties. Your tax rate's probably going to be 60 to 70% of everything that comes out of that trust. Foreign trust, not a good idea for U.S. beneficiaries. If you have a current beneficial interest, so you're listed on a foreign trust as a beneficiary that can take now, even if you don't get any distributions, you may have an 8938 reporting obligation. If you do get distributions, you definitely have an 8938 reporting obligation. PFECs. PFECs are the nasty word in our world. So PFEC is a passive foreign investment company. Now PFEC is what we most commonly refer to as a foreign mutual fund. So in the U.S., people, that invest in the U.S., we invest in all sorts of mutual funds, right? Those mutual funds are all over the world. All countries have mutual funds that they put out there. Rules on income that's earned in a U.S. mutual fund, certain percentage of it has to be distributed out. So, those of us that invest, we have dividends, we have capital gain distributions. Only a certain small percentage can remain in that mutual fund. Foreign mutual funds don't have the same rules. The IRS says we don't like that. So what the IRS says is you've got some options for these foreign mutual funds. All of it's going to basically cost you some money. So under the PFIC rules, the IRS looks at how to tax your investment in foreign mutual funds. For the unwary here, for people that haven't done their reporting properly but have been holding these funds. We talk about foreign mutual funds, and that's where we see PFICs generally. You can also have a PFIC if you have a family corporation that only holds investments. So we see it most commonly in Canada, but it can be in any jurisdiction. So you have a parent that sets up a corporation. The parent takes all their stock investments, bonds, whatever. They throw it into this corporation, and they keep some of it, and they give interest to their children. That's a PFEC because all of the income that's earned in there, or most of it, is passive income. So although mostly we focus on foreign mutual funds, family corporations that own passive assets can also be a PFEC. So for these funds, there's tax reporting that's required. And now, and in the last couple of years, this tax reporting is required every year that you own a PFEC, regardless of what's happening in that PFEC. So the first one is the Form 8621, to tax your tax return every year. So every year you have to say, I own this mutual fund, this many shares, this is the value, your tax return. And I've had a few clients from India that might own 40 or 50 mutual funds. Everyone gets an 8621 on the tax return. So the key word there is condense. So if you're going to invest in foreign mutual funds, it's not an absolute no, but don't invest in 40, you invest in like 5. Distributions from these PFECs, from the foreign mutual funds, have issues with them. So what the IRS says is, you know, okay, this PFEC earned income over 5 years. It's only just making a distribution now. That's fine. But we're going to assume that that income was earned over 5 years. So when you get that distribution today, number one, it's going to be taxed as ordinary income. Number two, we're going to assume that income was earned over the 5 years. So we're going to penalize you because you haven't been paying tax on that income equally over the last 5 years. So you get an interest charge on it. And then if you owe tax, you might get another penalty on top of that. So it's a bad plan for investing if you're not going to stay current with all of your filings. Now, there's elections that can be made to reduce the negative impact of a PFEC if you hold one, but the best elections have to be made in the first year that you become tax resident, or the first year that you own the mutual fund. So if you buy a foreign mutual fund today, and with your 2017 tax return, you're going to be okay with that PFEC. But if you bought one in 2012 and you haven't made any elections, you know, you've got some issues with reporting that, with getting caught up on that reporting, and reporting in the correct way any prior distributions, and also with how that's going to be dealt with today. And just as if it's not bad enough, if you sell this foreign mutual fund, there's no capital gains rates. So it's all ordinary income. All the profits are going to be taxed at ordinary income rates, and maybe with an interest charge just because. All right, Yao?
I just want to say one thing about PFIX is it's a passive foreign investment company, and you can have an active foreign company that transforms into a PFIC, and all the penalties come with it. And I have a client who he's a UK citizen, but now lives here in the US. His dad had an engineering company in the UK, and they ran it for many years, just a regular engineering company. And he gave his son several years ago 49% of the company, but it was active and it was operating. That was fine. No money came to his son. He just held the ownership interest. But then dad retired, and so the company stopped operating as an engineering company and was just holding assets, and it started holding just investment assets. So it became a PFIC, and so that means all that money that has been held there now is going to be attributed to the son, and that company invested in mutual funds. So we just got this client a couple of days ago, but a quick back of the envelope calculation looks like he owes the son, he's never gotten $1 out of this company, he owes just under $100,000 in US tax because of the PFICs that are in this company. So it's really important to keep an eye on, you know, investments in passive companies or family investments, because sometimes the holding company becomes a PFIC and unintended consequences.
Hi everyone, my name is Yao Tang and I'm associate at Vacovec and Mayotte and Singer LLP. I'm so honored to be here. Well, first of all, I would like to give a great A to everyone here. Well, just think about it. It's so chilly outside and it's a Friday night and you are still sitting here and listening such a boring topic, tax. Well, it just reminded me, when I was in law school graduate tax program, and I came to the United States firstly, and there was no class at all on Friday. And I was asking why. And the people looking at me weirdly said, life is so bad, and to learn tax is even worse. Don't be too tough to yourself. Now I understand it better. Okay, and with that grade A, I would like to wish everyone here has a wonderful year of Rooster. Happy New Year, anyway. And okay, and one more thing. Section will be very short, I promise. As Tonya and Arthur have introduced, so for the non-resident alien, if they own any interest of their foreign corporation, especially foreign corporation, usually it can block them from the U.S. tax consequences. But now I would like to discuss about the U.S. residents who owns interest in a foreign entities. Here I would like to talk 3 different types of entities: foreign partnership and foreign disregarded entity. Okay, first one is a foreign corporation. Well, Form 5471 is designed for filing purpose. Usually for the Form 5471, we'll ask for the identifying information such as the name, the address, when it was incorporated, and what's the business of that. And also the financial statements such as income statements and the balance sheet. And about certain transactions, that transaction could be between the U.S. shareholder and the foreign corporation, or the U.S. shareholders with some related parties that will have an extra filing requirement. Who should file? Well, that's a good question. But in that form, there is 4 different categories of people who need to file. And I would just summarize here. Basically, it's about the shareholder who owns 10% or more interest in that foreign corporation, or who are officers or directors of that corporation. And the last one is about shareholders of a controlled foreign company, which we call CFC. Well, the CFC is about the company, more than 50% of that stock is owned by a U.S. person. That U.S. person is actually only counted in that the shareholder who owns 10% or more. Well, here is a tricky thing. There is a constructively ownership rule will apply. For example, my husband owns 49% of a foreign corporation, and I own 2%. Well, the IRS will know, because they will know if my husband say yes, I cannot say no, right? So they will treat my husband, and my husband will be treated as the shareholder of 51%. Then that foreign company could be a CFC. Why I would like to point out the CFC? Because for the CFC, they may have some U.S. tax results. Normally, we know for the corporation, usually the shareholder will be taxed until they receive the dividends from that company, right? But for the CFC, they may be different. If it's operating income, the CFC earned operating income, that's fine. But if they have non-operating income, such as interest, dividend, rent, royalty, or capital gain, that will pass through to the U.S. shareholders, and it would be treated as they've earned during current year, even they didn't receive anything from that company. And second one is foreign partnership. Okay, Form 8865 is designed to disclose such interest in a foreign partnership. It's similar as a foreign corporation, basic financial statements and certain transactions between the U.S. partners and that partnership and related parties. There are 5 categories U.S. persons were listing there, but basically it's about like those partners who own 10% or more interest of that partnership, or it's a controlled foreign partnership, or during 1 year, a partner has contributed more than $100,000 to that partnership. And here it's also constructive ownership will apply here. And the U.S. tax rules we know, like because the partnership will just pass through. So there is no that tricky rule of the CFC. Next one is the last one. It's a foreign disregarded entity. So the definition is, what is a disregarded entity? Serious, I check it. So that means an entity not separated from its single owner for income tax purpose only. And there are so many different forms of entities over the world. Well, LLC in the United States means something, but LLC in China or in any other countries may be different forms. So the disregarded entity could be a choice or option for U.S. persons who own interest on it. The Form 8862, that's entity classification election, which we call like a check the box rule. So it says like, okay, if under the default classification rule, it's a partnership or LLC or certain types of corporation, the U.S. person can make a timely election to treat that interest in that company as a disregarded entity. So when? Timely, I just said timely, so when it's very important. That should be made within 75 days after the end of the first taxable year. Some exemptions, as someone said, everything is negotiable. If it's really delayed, let us know. We will help you settle. And the Form 8858 is designed for disregarded entity. So it's similar. It's identifying information, financial statements, and certain transactions. And who must file? There are three different kinds of categories. Basically, it's who is the sole owner of that disregarded entity, or who is U.S. shareholders of a CFC, and the CFC owns some disregarded entity, or the controlled partnership, foreign controlled partnership owns disregarded entity. The last part. Okay, it's about the penalties and deadlines. The deadline, because those forms will be filed with tax return, including extension, which means like April 15th of each year, or if it's an extension applied, it will be October 15th. And the penalty, I will just discuss about the worst scenario. The penalty would be $10,000 initial penalty for not filing timely. For example, like if my tax return is due on April 14th or April 15th, but I didn't attach it, well, then the IRS may issue a notice that, hey, you owe me $10,000. If I just threw it in the trash can, I didn't respond, then they say, okay, if you didn't file the form within 90 days, 30 additional days, there will be $10,000 more, up to $50,000. And the last one is the statute of limitations. It's open indefinitely until prop form is filed. That means if I didn't file the forms, the IRS can come back to me 10 years later and charge me or impose the penalty. Okay, that's it. See, I promise, it's very short. Thank you.
I just want to point out here that for some resources, for people who want more information on the non-resident alien rules, IRS Publication 519 does a good job on setting out residents, non-residents, source of income, and how the treaties work. So that's very helpful. And also the IRS website they've really done a good job over the last couple of years in upgrading their information. So you can get a lot of good stuff out of the website. And each form has their own instructions. So you can always check the forms and the instructions, good information. And of course, you can call us. We're happy to help.
Okay. And are these slides going to be posted on the website?
So the speakers today, they kindly offer to provide this slide on their company website, so you can download it.
No, it's on our website. Okay. Yeah, we'll get that up on our website in the next week. If you want it before that, ask Yao.
Okay. Yeah. Thank you very much. today to give us such an informative speech on the tax issues in the United States. Now the floor is open for questions.
So I have two questions actually. So my first question is, a small business in Canada, for example, obviously I will file the corporate taxes in Canada, right? And so I'm just wondering, like, for the corporate tax in US, like, do I need to just submit the difference, like between the corporate tax in US and the corporate tax in Canada?
You mean submit the difference for it's a Canadian company
Yeah.
and does it have US activity?
No.
You mean because you're the US shareholder?
So I'm like I don't have a bank card, but like I'm on EAP right now. So but all the activity and the income source is from Canada, right? So I will file the income tax like for my corporate in Canada.
Right.
So I'm just wondering if for IRS, do I need to like file all the income, like convert that to US dollars and file it for IRS as well?
You don't have to, if the company's not doing business in the US, then you don't have to. But once you become a US resident, for tax purposes, then you'll have to report the hours saying on that 5471 form.
Okay.
And what about the CFC?
Just following question. So on a year, say next year, it's a year between, so we become like resident of the US. And do we just report like actual income for that year? Or like US next year?
So what's your situation right now? You're on a J or F visa?
No.
You're on an L visa? How long have you been on the L visa for? Okay. Since,
Yeah, this year we're on tax.
so for 2016, you're non-resident, but for 17, you will be resident because you're on the L visa. Right. So now you're going to report worldwide income, you report all your assets
For all 17.
for all 17.
Shouldn't we just report by the day that we've reached one?
No, because once you hit that 183 days, then your residency period is your very first day in the U.S. So assuming that you were in the U.S. on January 1st, you'd be a full year resident. If your first day in the U.S. in 2017 wasn't until February 1st, then you would be dual status with residency starting on February 1st.
Also, what's the individual capital gain? Actually, there is a base, right? So before, let's say before, let's use some stocks example. And hold this stock for 3 years. And first 3 years, the standard is 130. And from 2017, you will become resident. So when you calculate, let's say for example, even you sell stock in 2017. So when you calculate the capital gain impact, what's the cost of the base? It's like 3 years ago or?
Yeah, because, so you only have one cost basis, so this could be your purchase price. So even though you were subject to tax in the first 3 years, while that stock was appreciating, we go all the way back to the beginning. You don't get any type of step up in basis or increase in basis. So you pay a U.S. capital gain tax on the full spread between your purchase price and sale price.
Okay, even the purchase happened like many years ago.
Yes.
Yep.
Yeah.
So how much for real estate?
Same.
It's same for all assets. So once you become a U.S. Resident, even if you've held the asset for many years before you were a U.S. resident, you have to use your original purchase price. Yeah, it's a bad result. We've always talked about that. It'd be a lot better if you could step up your basis when you became a resident, but that's not the rule yet.
So the better sell stocks first before you become a.
Yeah, and right, you then you buy back and come up with your ISS. Yeah.
Right, right, exactly.
So even sorry, this one. Within 2017, the status becomes green card. Then what's the base?
So it's going to be, it's all the same rules. So,
Still the purchase price.
yep,
All the way back.
yep, all the same rules. The same rules apply for everybody in that case.
So
realtor, I have some clients from China. They've always asked the same question. If I buy property in US, what's the best form? The second question is, should I add my kid's name into the title? In your opinion, what's the best?
Yeah, so, it goes back to what's their long-term plan. So if their long-term plan is they want that property in the name of the children at some point, then the best way to do it is, if the children are going to be U.S. resident, then you're going to be looking at maybe holding directly, maybe in an LLC, but getting it into the children's name to begin with. A bad plan is to have everybody on the deed. So the one plan we don't like to see, it causes all sorts of tax problems. Mom's on it, dad's on it, two sisters are on it, and now we're trying to get it into some sense. And you sell the property, everybody's filing tax returns. The basis is crazy. You've got gifting issues that happen. You've got a whole bunch of things. So multiple people on the deed is just not a good idea. But if the idea is to get the property in the name of children, do it. Gifting the cash outside the country, let the children buy it. And, parents are pretty good about controlling their children. They're not going to probably do it willy-nilly and sell it.
And if it's going to be, if the owners of the property are going to be non-resident aliens for a long time, then that structure Tonya was talking about, where you have a foreign entity owning a U.S. company that owns the real estate, really works nicely.
So it's a Chinese company owns
The U.S. company.
all.
And so it blocks it. So what I mean is on the sale, you can have one level of tax as opposed to multiple levels.
So I have to register a company and LLC in the United States, but for some reason I didn't really use that LLC. But I just want to during the tax return season, actually report tax or give an annual report, or do I need to do anything, or do I need to resolve it?
LLC here that's not operating, and this is Massachusetts specific.
Yeah.
And you're the only owner. You have anything to do with it. You have an annual report each year that gets filed to keep it going. But you don't have a tax return filed report. And I say that's specific to Mass because I don't know who's listening, but California, totally different rule. LLC has to file, regardless of what happens.
I do have a few partners, but I registered that the company is does that affect the outcome?
You don't have any income though?
No.
Okay, yeah, no, thank you.
So follow up with the question that Chinese investors want to buy property for their kids. Suppose the kid is below the legal age 18, it is still possible to put their name in the deeds.
Yep.
Okay.
So, especially with a lot of these deals we're seeing with the foreign investors or cash deals, you can hold property however you want. So, anybody could be an owner of the property. If you're doing a mortgage, you've got probably different restrictions or potentially different restrictions, but for a cash deal,
Okay, my questions are mainly focused on non-resident person, especially on the real estate capital gain. For non-US resident, from what I heard, the capital gain from the sale of real estate is not taxable.
So, the capital gains are always going to be taxable. The structure that we talked about, where you have a real estate, U.S. corporation, foreign corporation, the capital gains, the tax on the capital gains are paid in the U.S. corporation. Then when we liquidate out, there's not another level of tax.
But if it's held by the person.
Yeah, it's always going to be taxable. Capital gains are always going to be taxable.
Okay,
That 183-day rule doesn't apply to real estate. It applies to other assets.
If that's the case, if the person is holding real estate for over 5 years, will the capital gain exemption applies to the non-resident resident?
They're non-resident. It's pretty tricky to say that their U.S. house is their primary residence. Not impossible. Not impossible. The 2 out of 5 year rule, excluding gain, can apply to non-residents. but they have to live in the house, as they have to own it and live in it for 2 out of the past 5 years as a primary residence. So that means that,
That's the only resident.
well, then where do they live? So you mean like if they're a student?
Yeah, yes, and, or they travel back and forth.
So if they travel, so let's say they're on a tourist visa or B1, they've got to live somewhere else, or they're U.S. tax resident. So they're not. So if you're on a B1 for 5 years and you own a U.S. property, it can't both be your primary residence and you're a non-resident. So one of those doesn't work. And that one.
Could. I've seen that. We've had that situation where we've had students on F or J's, and then they've lived in the place, and then they've left, and sold it. And we could, in that case, you can take that primary residence exclusion. Yes.
Which means that because they're able to be in the U.S. all the time as a non-resident.
Right.
But it's not going to work for someone on a taxable visa.
Right. Exactly.
All right. So that's the case. Another question I have is the $60,000 exemption for non-resident. If they put the property real estate in a trust, would they be able to avoid that exemption?
Yeah, so if they put it in a trust, the problem with the trust is it may not matter if they die. It depends on the type of trust, but lots of times the ownership of the trust, because a foreign person, a non-U.S. resident, can't have a purely U.S. grantor trust. Yes, it protects it from the estate tax because it's not owned by the U.S. It's not owned by the non-resident. So yes, it does give it a level of protection.
Okay. I have two more questions, if you don't mind. If a non-U.S. resident owns a U.S. life insurance policy, and you guys would the death benefits going to a U.S. citizen be counted as toward the estate tax?
Generally, no.
So it's $60,000.
Remember that chart? What? Was on that chart. I don't recall.
Yeah, remember life insurance.
Email me that question. That doesn't
It's
come
not,
up.
right,
And
yeah,
I think the answer is not, but it could be. So email that question to me or to one of us, and we'll answer that because we have the answer. I just don't remember.
Yeah, I think
it rarely comes up.
Right, and I think it's not taxable.
That's for residents, for U.S. residents.
Well, yeah, the thing is bringing it back into the U.S. So I think it's not, but I would like to confirm that.
This is the person who will purchase the U.S. Life insurance policy left.
Yeah.
One last question.
Yeah.
For a U.S. Citizen, for example, owns multiple real estate in the United States, say China, can they do 1031 exchange?
So you can do a 1031 exchange. You have to go foreign to foreign?
It has to be foreign to foreign. You can't do U.S. to foreign.
Okay.
Yeah.
I have a quick question that's been learning. So I'm wondering how LS knows, like, whether I'm having a foreign account or a holding.
Yep. So as of January of this year, your banks are telling the IRS. So as Vacovec is the program the IRS has in place has been going on for about the past 4 years. And starting last year, midway through last year, but really effective as of the beginning of this year, your bank, if you're using a U.S. address, is going to report to the IRS that you are a U.S. account holder.
What they want to do with China?
What's that?
How about the bank accounts deal with China?
So, what's going to happen is banks are required to report their U.S. account holders. So banks are asking the questions. Now, for people like you guys, so from China, when the bank asks, what's your citizenship, you're going to say China. The question eventually is going to be, what are all of your citizenships? Or it's going to be, are you a U.S. resident, green card holder, citizen? That's when you're going to get reported. So right now, if your bank doesn't know you're a U.S. person and you're not using U.S. address, then you're probably not going to get reported yet. But eventually, the banks and the IRS, they're working to perfect that system so that eventually everybody gets reported.
I can put something more. I think the news, what I've heard, from January 1st to 2017, the banks in China, they have started the procedure to check, their account holders, whether they are U.S. non-U.S., non-Chinese residents. So they're starting to field. Now, I think they said like the per shareholder like $300,000 RMB, but it's starting.
But my one point on that is, but there's a lot of banks and there's a lot of people out there that the IRS won't know about because certain banks aren't going to do business with the U.S. and so the IRS doesn't know a lot of situations. So it's up to the taxpayer to report it themselves, or you take a risk that if you're not going to report it, well, maybe if I keep my head down, the IRS won't find out. But then the question is, what's your risk tolerance? Because the penalties are big, so can you sleep at night? Right.
Yep. So can you compare technology against technology? Each of the services and costs. And of course, can you suggest what kind of services that you find technology? And what services do you
So our firm is, we're a tax law firm, but we perform a lot of services that accounting firms perform. The work that we do here in the international compliance, unless you go to a very common accounting firm, they don't do this work. So our competitors on tax compliance, especially related to high net worth individuals with foreign assets, are going to be your very large accounting firms and your higher end mid-level accounting firms. Your CPA down the street, they're probably not going to touch this. Once you start dealing with the IRS, when we're working with the IRS on some of this disclosure work, we have some confidentiality with the clients that CPA doesn't have. When we get into the tax code, and we're taking the tax planning that we talked about today, not anything you would want to go to a CPA for, whether it's us or somebody else, it's got to be someone that has really good knowledge of the international tax rules. CPAs, their job is to know the U.S. rules, and they do a lot, and they cover a lot of areas that we won't cover. If you have an earned income credit issue, don't come to me because I don't know that. But when you're dealing with international tax issues, that's what we know. Fee-wise, accounting fees are all over the place. We are much less expensive than downtown firms because we're in Newton, so we're right at the fight in Newton Corner, just outside Boston, easily accessible, but we are just outside Boston, so our fees are a lot more reasonable. We're not going to do a $300 tax return. So, people with really significant issues on reporting that they haven't done come to us. We're reasonable enough that we can deal with people with small prior year reporting issues and get them done. We deal with a lot of accountants. A lot of our clients are accountants who are referred to us by accountants, and we work with the accountants. So if you come to me with a problem, you have a CPA that's been doing your return. I might work with that CPA to get your tax fixed, not say, oh, I'm only going to do it if you use me for everything. So we work with and we educate the CPA accounting community, and a big part of our practice is working directly with them on their compliance with their clients.
And one other thing is when you're dealing with entities, when we're dealing with individuals, there's a lot of overlap with us in the accounting firms. But when we're dealing with entities, if you need financial statements, balance sheets, things like that, then that's what the accountant's for. That's something we wouldn't touch. Yeah.
And my wife is in the process of getting green cards. About $10 million invested in the project equity. What is the best structure for them to minimize the costs?
So, is the husband a U.S. person?
Husband Chinese.
And not a green card.
No, doesn't want to be a green card.
Doesn't want to be a green card. And the wife will be a green card. So, what we start with is looking at how much the wife is willing to move out of her name. So that's going to be, the first type of thing, and it might be none.
It's very flexible.
Yeah. So then we start, moving around assets and working in that type of situation. We would generally make sure that we're at least working somewhat with a Chinese lawyer to make sure any movement that we're not creating a problem in China with the tax structure. But that'd be something we'd have to look at all the facts. I don't know off the top of my head what the best structure would be. and when we're looking at transferring assets, depending on where those assets are, and depending on whether we're going to create any kind of tax consequences on transfer, then we would determine the best structure to keep her U.S. tax liability at a minimum for income tax and estate tax purposes.
For U.S. citizens on this platform, who just want to invest in real estate, what's the best way to do that?
So usually for just a straight U.S. person, we'll use an LLC, and it's always taxable. So the LLC is going to bring you the least rates, the lowest rates. You know, it's going to be the same as your individual rates. There's not a lot of tax planning that goes around that type of investment. You might put it in a trust. Trusts pay higher tax rates. So if it's a grant or a trust, it's invisible. Again, it all comes back to your tax return. Usually, if we're looking at an individual investment in U.S. real estate, tax consequences probably aren't the biggest thing we're looking at. What we're looking at is liability issues. So you use an LLC, make sure it's properly insured, and you're protecting the rest of your assets from any liabilities related to that. There's other options. Some of them the IRS is frowning on. There's some limited partnerships that you can use where you can reduce some values and families can own together. But some of that the IRS is taking a negative view of these days. So yeah. Yep. But what they do is it's subject to estate tax, but at a discounted value, which is why the IRS doesn't like it. So if we three owned it together, they said my third isn't really worth under what we try to do. My third's not really worth a third. It's only worth, let's say, 20% because these two cannot vote me on everything. I would reduce that from what my 33% would be to like 20%, and the IRS is like, you know, that's been a very popular planning technique that's going on. The IRS is really kind of, we call it minority discount. The IRS is really squishing it down and not liking it very much, and it's come out against it in a lot of cases. So, you know, it depends on who the owners are going to be, but there's not necessarily a lot of planning you can do around it. If you look at, you know, if you're looking super long term, there's a state tax planning you can do, a lot of income tax planning.
So instead of LLC, can I utilize the umbrella insurance to cover the
Yeah. We know that. Yeah. So the LLC certainly is a bulletproof. You know, meaning with an LLC, you know, they can still come after you. It just gives you a level of protection. But always what we say is if you have a rental property, insure yourself. Well, insure that property or yourself or however you want to deal with your insurance agent, the umbrella policy. But make sure you're protecting your other assets against that rental property because things can just go backwards.
Well, and the LLC is it's cheap insurance. You know, in Massachusetts, it's $500 a year. So it puts that box around the real estate and will protect you. So if someone slips and falls or something happens in there, it does protect you. So I think the umbrella insurance is a good idea, but that for $500 a year, that's a cheap premium if you think about it. To reduce the gift tax.
Is it here in the U.S.?
U.S. property worth $10 million.
Oh.
Less than 10 million.
Yeah, and that's the problem, that there's not a lot of good ways to reduce it. What you can start doing, you look like a young man, so you can start getting pieces of interest in him under the exclusions that we talked about, but if it's worth $2 million, you know, you're not going to really make a dent in it, and that's, you know, that's the exact reason why doing your planning before you make a purchase is important, because right now, there's not a lot of ways around the gift tax. So if you own that property, one of the things I was talking about with another client is Unless that's a property that you just can't give up, it might be cheaper to sell the property, pay your capital gains tax, rather than pay the gift tax or estate tax. Capital gains taxes are a lot lower. So that's one planning opportunity. I was just talking to a client the other day that has that exact same issue, has U.S. property that he wants to get to his kids, and that's probably what we're going to do. And he's not married to the property, so we'll probably sell, pay the capital gains tax, and then at least he's got, a lower tax liability, not no tax liability. Can you sell it to his son?
Yeah, and also use the city and deed to the son.
Yeah, so what I have seen, if you have money outside the U.S., the one plan that we did with somebody else we were looking at is, if you've got money sitting outside the U.S., you can gift that money to your son and let him hold it for a while. So don't do this all in 1 week, but let it sit there for a while so that it's really clear that it's his money, and then he takes that money and buys property. So, you still have maybe a capital gains tax, but you're going to get the best purchase price possible, and you can also do a piece of it as a gift. So he might buy it at a reduced value, so you have some purchase and some.
Can you do something like dynasty trust?
Yeah.
Dynasty generation? Grandson?
Can you do a dynasty trust?
Right.
Yeah. So you still have some gift tax issues that are going to come into play when you're doing the trust, and looking at age and looking at the tables, and I don't know how old you are, but maybe you have some ability to avoid some of the gift taxes in that way. But again, you're wrapping it up in a trust, so it kind of depends on what your long-term plans are. Is he going to keep it? Is he going to sell it? What does he want to do with it? And do you want to get it into his name individually, or putting it into a trust or dynasty trust for future generations, where half of the real estate, but you have cash in there. So that's a potential opportunity. But in your type of situation, to kind of looking at everybody, they're complicated situations, and you're looking at your family dynamics, what your available assets are, what your long-term plans are. So each situation in some context has to be looked at individually to see what works for you.
Okay, thank you so much for